Okay, we'll get started. Welcome to the 2012 World Dairy Expo. Today's seminar, Making Sense of a Global Dairy Markets, is sponsored by Zurex Pharmagra, which I represent. The speaker today is Alan Levitt, Vice President of Communications for the U.S. Dairy Export Council. Alan was recently named as Vice President of Communications at the U.S. Dairy Export Council. However, he's been working with the Council since 1995. Prior to joining the Council full-time, he ran his own marketing and consulting firm, Levitt Communications, for 11 years. Levitt has over 25 years of experience studying and researching the global markets for the dairy business. This seminar has been approved for continuing education credits from the American Registry of Professional Animal Scientists and the American Association of Veterinarian State Boards RACE program. The forms are available in the back if you're interested in RACE credits. If we could all silence our phones at this time, I'd like to welcome Alan to the World Dairy Expo, and looking forward to the presentation.
Thank you, Mike. Let's get rid of this one. Okay. How's that? All right, I'm glad to see you guys got past all the police barricades and the helicopters and all that to get to this presentation. I know it was a high security event and everything up in Madison. We were going to have it on Bascom Hall, but decided to move it here. Liz called me, I think it was probably back in March, to do this presentation, and of course you got to come up with a title, and at the time, so I just, I brainstormed and I came up with this, and then a couple weeks ago, an editor was doing one of those pre-expo show issues, and she was asking me questions and said, is it even possible to make sense of the dairy markets, the global dairy markets? And it's a good question because it's confusing at times, but we still have to try because we are in fact part of a global market, and we're no longer insulated, and we have to pay attention and try to understand what's happening around the world. It gets challenging, and sometimes I liken it to even like the serenity prayer. It's like, grant me the serenity to accept the things I cannot forecast, the courage to forecast the things that I can, and the wisdom to know the difference. Because, we get hit by these curveballs all the time. I mean, people don't see global financial crises coming, or political things, or nobody saw the summer drought coming. So that's what we have to deal with. I should probably get a clicker. All right. Here's the stuff I'm going to talk about. I'll give you a little bit of background about the U.S. Dairy Export Council. We have to talk about globalization. I'll share with you a few of the drivers that I watch, and then if we still have time, we'll talk about what's on the horizon. So first, a word about the U.S. Dairy Export Council. It was formed in 1995, producer and processor joint effort to focus specifically on exports. It's grown to about 115 members. The membership list reads pretty much like a who's who of the dairy industry. It's pretty much every major company. It's also allied members, traders, suppliers to the industry, everybody who wants to know what's going on in the global markets. We have a staff in Arlington, Virginia, and then also in-country representation in 8 overseas offices in covering 13 markets around the world, and they help provide us on-the-ground competitive intelligence. Now we get funding because I know there's farmers in the room, so we actually get funding from dairy farmers through the checkoff program. Almost 3/4 of the funding comes from dairy farmers. A little less than 1/4 comes from USDA's Foreign Ag Service, and then about 4% comes from membership dues. So in all, farmers spend about a little less than a penny per hundredweight to support export market development. To clarify what USDEC's role in all this is, in truth, we really can't have that much impact on overall market conditions. You know, we can't change business cycles and we can't drive population growth, we can't raise per capita incomes, and we don't sell product. But for a reasonable investment by the industry, US DEC helps exporters make their way in what's become a really complex environment. And we primarily do this in two ways. We help suppliers understand and capitalize on the opportunities in the global market, and we help them minimize the cost and risk of exports. And this is especially important in a globalized business. So I mentioned that US DEC was formed in 1995, and that's not just a historical anecdote. That actually was a critical turning point for the US dairy industry. And I can't even overstate how dramatically different the world is today than it was back then 17 years ago. And so, I mean, if you want to start to make sense of the global dairy markets, you know, here's some of the major differences. You know, back then, milk production growth was much slower. It was, you know, we were growing less than 1% a year. Now we're closer to 2% a year. Back then, less than 4% of our production was sold overseas, and nearly all of it was subsidized or donated, whereas today, more than 13% of our milk production gets sold overseas, and almost all of it is commercial sales. Back then, we were almost totally insulated from the world markets, and now we're almost fully integrated with world markets. Back then, dairy trade was more distorted with subsidies and heavily protected markets, whereas today, dairy trade, while there's still trade barriers around the world, it's increasingly more open. And back then, there was little dairy consumption outside of the developed markets, and now, because there's tremendous consumption growth in emerging markets. Overseas buyers couldn't really afford US dairy products back then. And because of the tremendous GDP growth in emerging markets, overseas buyers now can afford to buy US dairy products. And then just structurally, back in the mid-90s, there was more of a bias towards oversupply in the world markets, whereas today there's more of a bias towards undersupply. So here's another thing you have to understand to make sense of the global dairy markets. You have to consider the competitive space that we compete in, and this is our position. This chart is showing total milk production, and hopefully you guys can see that in the back. It's total milk production, and then the red part of the bar is what proportion of that goes to export. So you can see, like New Zealand, almost all of what they make is exported. Australia, close to half. The United States and Europe are in that similar range between 10 and 15%. Whereas other countries, India, Russia, China, Brazil, big milk producing countries, but they're not really exporters. And all this matters because the US is still made up of a diverse range of individual suppliers, and we're still kind of a relatively fragmented industry compared with like New Zealand, for instance, or the Netherlands or Ireland, which are all more integrated and more export focused. So one of the functions of the US Dairy Export Council is to kind of bridge that gap, to provide some of these integrated resources to help individual suppliers compete in a space that's really dominated by more integrated players. You can also see New Zealand accounts for about a third of world dairy trade. Europe is close to a third. The United States is in that 15 to 20% range. Australia is 5 to 10%. So that's that's another thing to keep in mind. And so here's what it's come to. We now export more than 13% of our milk supply. That means nearly 1 out of every 7 tankers that rolls out of the driveway is ending up being sold overseas. And you can also see what a dramatic and steady increase we've had over the last, since the mid-90s. I mean, it's continually tracked up, other than, that dip in 2009. And that has significant implications. When you're exporting 13% of your milk supply, it means that you're fully exposed to the global markets. I take for granted sometimes, I'm kind of a chart geek, so I apologize if you're not like real chart oriented, and I'll try to walk you through these. I overlaid the US all milk price is the blue line, and the Oceania skim milk powder price is the red line. And you can see over the last 7 years, these things have tracked at almost a 90% correlation. So that's why you need to pay attention to global markets, because it's really all just one flat market now. It's not a here or there thing. It means that what happens outside our borders impacts what happens here. it's all linked. And I should point out also, it's important that we export consistently. We don't want to have large swings in volumes that ebb in and out and disrupt our markets. And, of course, we learned that lesson the hard way in 2009. This chart is showing the red line is the percent of our production month by month that's sold overseas. The blue line is an export volume number. And back in 2009, we lost some export share, and all that product backed up on the domestic market, and then we had to clear it here, and it was problematic, as you all know. So fortunately, we've had a much steadier presence since the spring of 2010. We've been between 12 and 15% of production every month for the last 28 months, and so that's been a good thing for us. I also here's another fun chart. The blue part of what I'm showing here is incremental growth in production and exports. So starting with 2003, the red part of this chart is the growth in our U.S. milk production, total milk solids basis. So we've increased like 3.7 billion pounds, which is good growth. The blue part is our export increase over the same time, and that's been about 2.2 billion pounds. So over the last 7 years, more than 60% of the new milk, actually it's 9 years, over the last 9 years, more than 60% of the new milk has gone to export. So that's been important as well. More charts. The U.S. dairy sector has benefited as much or more than anyone actually from this globalization. These are the 5 major dairy exporters, and over the last 7 years, U.S. milk production is up almost 23 billion pounds. That's the red line. Europe is the blue line. They've been up about 13 billion pounds. New Zealand is up 12 billion. Argentina up about 5.5 billion. And Australia has actually lost about 1 billion pounds of milk production. So globalization has allowed the U.S. dairy industry to grow, but it does pose some new challenges, and it means we have to track a lot more things. So let's make that go forward. There we go. So I will talk about 5 of the major drivers of the global dairy markets. And they're mostly the same ones that drive the domestic markets, actually. And a lot of these are predictable in a directional sense, but they're unpredictable at the margins, and we're always going to be blindsided by the black swan events and something that's just off the charts. I mean, we can't foresee droughts or earthquakes or political or economic crises all the time. But, we still try to make sense of the global dairy markets and, assess the market conditions with what we have. So driver number 1, milk production and supply. And that, just like here, it's a function of weather and farm gate milk prices. This chart is showing percent change for the 5 major exporting regions: Europe, United States, New Zealand, Australia, and Argentina. Percent change year over year since January of 2010. So, clearly we're coming off 2 straight years of really strong growth. Production in these regions was up 2.9% in the year ending April of 12, and that amounts to 18.5 billion pounds of milk. That's like adding 2 Minnesotas of milk production over the last year. And that came after a year of 2.8% growth. So a tremendous swell of volume there that came out of the world market. Fortunately, global demand was able to absorb most of it, but ultimately it overshot. We also see from the chart that in May, June, and July, production was up just 1%. So, the curve has really dropped off since the spring. And that's been the big story of the global dairy markets over the last few months, the slowdown in global milk production. Europe had weather issues as well as we did, so their milk deliveries were up just 0.3% in the May-July period. The United States, tight margins and the drought. Production was up less than 1% in June and July and down in August. Cow numbers have dropped 51,000 head over the last 4 months, and slaughter rates are running 10 to 15% ahead of a year ago. So that accounts for a lot of this slowdown. Growth in the southern hemisphere is offsetting some of that slowdown. I mean, New Zealand is coming off a record year. Conditions are favorable for a strong start then again in their new year. Output was up 13% in the May-July period, coming off a year where they were up 10%. So they're looking real good. There had been some fear that an El Nino might impact production, but at this point that seems less likely. Australia production was up 4% May to July, and then they're expecting a 2% increase for the year. Argentina production was up 5% May to July. I think that they seem to be kind of slowing down a bit because the high feed costs, cropping gives them better returns, and so they can kind of shift things over that way. And so because of this slowdown in production, stock levels have declined, particularly on milk powder. Globally, milk powder stocks are really low. I did this chart back in May, so I kept it, but it's showing United States and Europe milk powder stocks, or skim milk powder stocks and butter stocks. And Europe and the United States have no government stocks anymore. Commercial stocks are very light. At mid-year, stocks were just a quarter of what they were 2 years ago. The data is from late May, but the trend has continued. U.S. non-fat stocks are at a 6-year low. They're just half of what they were back in April. So that is going to be problematic. Meanwhile, New Zealand liquidated most of its holdings in June and July, and so without this buffer, and because of the slowdown in production from Europe and the United States, I think prospects are good that supplies are going to be severely short by year end. I mean, we supply 30% of the world's non-fat dry milk, skim milk powder, so if our supply drops off, that's going to have a global effect. Driver number 2, consumption, the other side of the picture. And that's going to be driven by demographics and economic factors and price and even substitution options. And we like to say around the Export Council that the demographics are inescapable. I mean, you have rising GDP, growing population, westernization of diets, expansion of fast food. We've seen dairy more entrenched in the diet. And just some factoids, I mean, there's nearly 16 million babies born every year in China. And these babies are increasingly fed dairy-based formula and weaning foods. You have school lunch programs throughout the developing world that are putting milk in front of children for the first time, and they're developing that taste for dairy. The World Bank expects the global middle class will climb from 430 million in 2000 to 1.15 billion in 2030. It's the same story: robust economic growth, urbanization, rising purchasing power. In Indonesia, the number of people considered middle class will double by the end of the decade. McDonald's has 1,500 stores in China. They expect to have 2,000 next year. KFC is opening 500 stores a year. India is actually considered an even hotter market than China. The Middle East is very strong. So consumption has been the big driver. You saw that milk production growth over the last 2 years, but that growth wouldn't have happened if consumption wasn't pulling it along. The flip side of that is that consumer purchasing power will increase or will impact this consumption. And we're seeing some of the evidence that the shakiness in the global economy has put the reins on some of the growth in dairy use over the last year. This chart is imports from 6 major buyers: China, Southeast Asia, Russia, Mexico, Algeria, and Japan. And it's a basket of products. It's aggregate volume of milk powder, cheese, butter, fat, and whey. So, I mean, it would be kind of impractical for me to get every country and every product. So this is kind of a proxy of imports from the major buyers. And I've put it on a rolling 12-month average to kind of show the long-term trend. And dairy trade has increased significantly from 2009 to 2011. It's plateaued since then, and so it's actually just been steady over the last year. And I think some of the global economic issues are we can attribute to that. But still, in the first half of this year, imports from these buyers were up 27% from 2009, and that's been the major pull on the world's milk supply. And just to go, I mean, as far as some of the individual countries, I mean, in the first half of this year, dairy imports were running slightly ahead of a year ago. We've had gains in China, from China and Mexico, but that was offset by declines from Russia and Algeria. When you're talking about global dairy consumption, you always have to pay close attention to China, because after the melamine crisis in 2008, imports have increased significantly. This is imports of whole milk powder, whey, and skim milk powder. And you can see the big jump and this is quarterly, so you can see the big jump from third quarter of '08. Consumption continues to grow, especially for infant formula and weaning foods, and because parents just don't trust the domestic supply. Imports have actually tripled since 2008, and in truth, New Zealand has been the major beneficiary of this, but we've also benefited because we backfill some of the markets that they've had to let go. In the first 8 months of this year, China imports of milk powder and whey were up 23% from a year ago, and I don't see that slowing down anytime soon. I mean, there's certainly some investment in domestic production in China, but it's nowhere near enough relative to overall consumption, and they just don't have the infrastructure, and their cost of production is just too high. I mean, it still costs them less to import their dairy needs rather than produce it themselves. Of course, demand is also a function of price. In this year, buyers have taken advantage of prices that were historically low. So August of 2012 prices were down 20 to 30% from a year ago. This chart is showing Dairy Market News world prices of milk powder, cheese, butter, and whey since the beginning of the year. And so like I said, August prices were below a year ago, and in fact, over the last 5 years, the only time they were lower in August was 2009. So in other words, on the world market, dairy has actually been a pretty good bargain this year, and the low prices have kind of helped stimulate some use and offset the effects of slower GDP growth. So when prices started to rally this summer, they actually had some room to come up, because you can see they haven't even returned to the levels that we had in the first quarter of this year, and there's still not too much buyer resistance. There's still supply concerns on milk powder, and that's going to persist, but at this point, we think there's still some room to come up. Switching gears for a second, I'll come back to price in a little bit, but switching gears, a third driver is policy. And usually this kind of helps establish like long-term dynamics. It kind of defines who does what, but sometimes it has short-term implications. And just as a few examples, like New Zealand has preferential access to China. So China buys large quantities early in the year when it's cheaper until their quota is filled, and then it kind of drops off. EU milk production quotas will come off in 2015, so some of their countries are starting to position for faster growth, like Ireland. India, not a factor in the global trading system because they have a protected industry and they don't really do much exporting or importing. Occasionally, they'll allow some exports or imports and to balance their market, and that sometimes has a little effect on the world market. But right now, India's in a surplus situation, so they won't be importing anytime soon. Canada, not a factor on the world market. They have limited exports because of their supply management program, limited imports because of their tariff walls. This isn't really a factor now, but in the past, you always had to watch when the EU would implement export subsidies, or if we kicked in our DEEP program, and then that would have an effect on the markets. We even have to pay attention to government policies, like China. They're going through a leadership transition this year. Every 10 years, they have a new leader, and next month, they'll announce a new leader, and so we have to kind of watch. Does that mean they have to, will they try to keep inflation low? Will they have more government stimulus or something? It all kind of factors into the mix. We jump back to price again, because the pricing relationships, this is the stuff I get a kick out of, because the prices are all tethered to each other. They're all interrelated and interdependent in a variety of ways. And so when one increases, it always has an effect on one of the other prices. So this is the corn price versus the U.S. all milk price. It's a rolling 12-month average to kind of smooth things out. And they don't always sync up, but I mean, the U.S. milk price roughly tracks the corn price. This year, obviously, it hasn't followed all the way up, and that's problematic. But ultimately, they do have to align. I mean, if corn were to stay above $7, then our milk price would have to be $20 or $22. Otherwise, we wouldn't have the supply to satisfy needs. Those relationships also come into play regarding substitution, because if dairy prices get too expensive relative to vegetable proteins like soy, then dairy consumption would drop off. People would switch. So currently, substitution isn't really an issue because the grain prices are so high, but it's one of those relationships we have to watch. This is getting a little bit down in the weeds, but protein prices also sync up. I mean, milk powders and whey proteins have to kind of track each other because in some applications they're interchangeable. So right now, U.S. non-fat and dry whey prices have moved above the WPC price. So I would expect that the WPC price would have to increase in the months ahead. That's the green line, whereas the red is non-fat and blue is whey. We see other connections like. Yeah, I'm sorry. No, you're okay. It's not necessarily a following. It's more that they kind of have to track each other. It's not that, like, sometimes milk leads and sometimes corn leads, but ultimately, I mean, I think the price. Yeah, I guess the premise I'm trying to make is that ultimately the price of milk has to reflect the cost of production. Yeah, yeah, yeah. I mean, I think if you had $7.50 corn, you couldn't have $15 milk. I mean, it just wouldn't pencil out. Ultimately, they would have to sync up. So I guess that's the point I'm trying to make. But yeah, I understand what you're saying. Other relationships. Obviously, in the returns, like the returns on milk to go into cheese versus to go into butter powdered versus go into whole milk powder, those all have to sync up as well. I mean, you can't have $2 cheese and $1 powder because the milk would flow from the lowest value to the highest value. So eventually, those supplies would balance. I mean, right now, things are pretty well in sync. There's not really one commodity pulling the other. But it's still something that we keep track of. All right, this one is critical because in a flat global marketplace, dairy commodity prices from different sources are going to weigh on each other. This is the Dairy Market News Oceania price and the U.S. CME cheese price, weekly average. Right now, the U.S. block cheddar price has moved above the Oceania price by a noticeable margin. And these are levels that were typical prior to 2006 and 2007, but we really haven't seen this much in the last 5 or 6 years. And I mean, I think in a flat global marketplace, the Oceania price puts a ceiling on our price. I mean, I don't think we can sustain cheese prices above $2 if the Oceania price doesn't come up as well. I mean, otherwise we attract imports, we discourage exports, and our prices kind of fall back in line. So those are the relationships that we track. And butter is in a similar situation. I'll show you on the next chart, where our price is well above the Oceania price, and non-fat skim milk, our price has also moved up to beyond where things had been. And these competitive dynamics are really important. International prices have come up about 10 to 20% over the last 2 months, maybe 10% from Oceania and 20% from Europe. And they have room to come up a little more, like I said, but with New Zealand poised for another strong year, I don't know if Oceania cheese prices are ready to get to $2. And so that may mean that our cheese prices have to pull back. And I don't know that Oceania butter prices are ready to get to $2. So that may be a drag on our markets as well. I do think world supplies of milk powder are tight enough that I think the Oceania price is going to have to come up higher near ours. Here, these are probably really small for you guys, but that's non-fat on the left, butter on the right. The blue is Oceania, the red is the U.S. and this is where things get kind of delicate because U.S. producers, of course, are stuck between these higher feed costs and world markets that don't always cover our cost of production. And obviously, we see the upshot of that now because U.S. production is declining with that margin squeeze. Let's back that up a second. No, let's go to that one. Okay, so where is that next equilibrium level? I mean, I don't know how precisely this is going to play out because there's pressure to push prices up from tight supplies, but food inflation in the coming months is going to put consumption growth in jeopardy. And as these higher commodity prices get passed through to consumers and then overall food inflation becomes more critical, particularly in developing countries, consumer purchasing power is going to be eroded. And so it's going to kind of be this push and pull to reconcile the desire to push prices higher and buyer resistance. And the market, eventually, it always does find the price where supply and demand reach that equilibrium, but we're certainly going to have some volatility along the way. For now, the lower cost suppliers are going to fare better, and that's going to keep downward pressure on our prices. Today, I'm not sure the world needs our milk solids enough to pay $2 a pound for our cheese, butter, and non-fat. The encouraging news is that the low cost suppliers can't supply at all. The volume needed is just too great. So, I mean, based on that milk production chart that I showed you earlier, I mean, we think world milk supply is probably going to be short by 2 to 4 billion pounds next year. So maybe in a month or two, but certainly by next spring, supply is going to be tight enough that the world is going to need our milk, and I think they're going to have to pay for it. And I don't necessarily think this is a temporary phenomenon. I think food and dairy prices have moved to a higher level again, and that's what I'm talking about here with this equilibrium price. I showed you this chart before without that pink shading over it. Over the last 6 years, the world skim milk powder price, which is the red line, that's kind of fluctuated around an equilibrium point of about $3,300 a ton, $1.50 a pound. That's been the average over the last 6 years. It was the average from 07 to 09, and it was the average from 10 to 12. I think we're entering a phase where that equilibrium price is going to have to be at least $3,600 a ton. That would be $1.65 on skim milk powder, non-fat. So I think we're moving up to a higher level there. Getting off prices for a second, the fifth driver is psychology, and that can be the toughest to predict of all, and it can trump all the other factors, even the specific economic factors. And it's the same in the domestic market. I mean, the world market is made up of buyers and sellers, and they're trying to manage inventory, and they're trying to maximize profitability. And if buyers perceive, or if they even anticipate that supply is going to be tight, then they just get more aggressive in their purchasing. And then, on the other hand, if there's no threat to supply, if they don't feel like that panic, then they get more passive. And then manufacturers have to lower their prices to keep inventories from building up. So we saw that play out this summer. The prospect of tightness because of the U.S. drought changed the market psychology. Normally in the summer, like in August, there's not a lot of market activity because Europe's on holiday and Oceania's in their off season, and so not a lot of business gets done. But then, we saw a lot more early buying this summer, and it firmed the markets at a time that they're typically quiet. And then, Europe was having their weather issues. Oceania doesn't have anything to sell in their off season, so that kind of compounded the fear that things were going to be really short in the months to come. So users just bought early to hedge against shortages in the fourth quarter and into 2013. So in the last few weeks, it's actually kind of plateaued, and prices, buyers have kind of pulled back. They're kind of reassessing where they're at after that run up, waiting to see how those prices can be passed through. They're waiting to see how Oceania's production season comes on. Ultimately, I think it's still going to have to pull higher. And I should point out that the market psychology can become self-fulfilling. I mean, buyers see prices going up, so then they might buy an extra load. And then if a bunch of buyers do that, then the market does really become short, and it kind of feeds on itself. I will finish up with a few thoughts on just some of the longer-term factors, because like those 5 drivers that I talked about, those are the things we look at like on a week-to-week, month-to-month, quarter-to-quarter basis. But then there's always things that are kind of overlaying the whole markets, macro things that kind of drive what's happening out there. I mean, we know global demand is going to continue to grow and it's going to pull global supply. I mean, like in the chart that I showed earlier about the difference between then and now, I mean, we're in a structurally short time now, and that's been pretty well established. It means that prices are probably going to have to move into a higher band. Fortunately, you know, China and some of these developing countries, they're willing to pay at a higher level, and that's enabled the United States to become more competitive and a more active participant in global trade. I mean, we don't necessarily regard exports as a lower value proposition anymore. The export market offers returns that are at least as good or better than the domestic market. We also know that milk production is still too expensive to produce in some of these importing regions. I mean, trade is going to be necessary, and I think the price of milk has to reflect the cost of production in the regions that are going to be able to supply it. It also means that higher farm gate milk prices have spurred production around the world, both local production from some of these importers as well as production from traditional exporters. We know that Europe is gearing up for quotas to come off, and you know, anywhere that people can produce milk, when the prices go up, then they will. Global food security is going to be even more critical in the years ahead, and I have, you know, I don't know how this is going to play out. I mean, one implication is that we're seeing some of the emerging importers, they're trying to get greater control of their own food supply, so we see China investing in other places like Africa and South America and Oceania. Water availability is becoming increasingly critical, and we see this in, you know, even in the United States, where dairying is going to take place over the next 10, 15 years. The other implication is the global food prices, including dairy, are just going to remain volatile from here on out. I mean, I don't see any way around that. The supply-demand balance in almost all agricultural commodities has tightened to a point that any shock to the system has dramatic price impacts. I mean, especially negative supply shocks like extreme weather. You know, and of course we saw that this summer. There's the corn futures graph that hit us this summer. So, you know, the food inflation spike that's coming in 2013, that's definitely something that we have to keep an eye on. Just some other little things that we kind of watch. I mean, I think India could be the next China, maybe 5 to 10 years. I mean, they're going to have to start importing volumes greater than, you know, right now they're relatively self-sufficient, but there will be a point at which their purchasing power increases enough, and they're just not going to be able to produce it. They don't have the infrastructure, and they have ambitious goals for building infrastructure, but I think ultimately they're going to have to be a bigger importer. The low end of the consumer pyramid, we don't talk about a lot, but that I think is going to become a larger opportunity in years to come. And what I'm talking about there are smaller, lower cost introductory products for very low income consumers in the poorest countries, like those in Africa. I mean, we see Nestle and Danone doing things like little single serve things that might cost 9 cents or 13 cents, and it just introduces consumers to dairy and gets their foothold in there, so that as Africa becomes more wealthy, you know, they'll be consuming more dairy as well. I think it also goes without saying that suppliers that can maintain an impeccable quality and safety record throughout the supply chain, they're going to have a competitive advantage. You know, that's one of those things we never know when that can completely derail a market. I mean, ultimately, as the global dairy business expands and matures, I mean, dairy suppliers are going to align where they have the best competitive advantage. I mean, not everybody can supply everywhere. So, you know, for the United States, that's Mexico and Southeast Asia for milk powder. It's cheese for food service worldwide. It's protein throughout Asia and Latin America and the Middle East for health and wellness foods. But our competitors aren't standing still either. You know, they're making heavy investments in processing capacity outside the United States. The U.S. isn't doing a whole lot relative to what some of the other countries are doing. So, you know, hopefully our suppliers will see that opportunity and move a little bit more aggressively overseas. I will leave you with this thought. You know, it's a tough time to be dairying, and you know, and certainly, you know, the world economic news is kind of sobering. But actually, I am actually kind of comforted to say that the dairy industry is actually still very much a growth industry. I mean, we take that for granted, but it hasn't always been a growth industry. From 1941 to 1975, even though we had the baby boom and we had a consumer culture, milk production was flat. And since then, the industry has steadily expanded. And so if you view it from that wide lens, I think the dairy demand story of the last 30 to 40 years was probably driven by pizza and other fast food in this country. But if the industry is going to continue to expand, you know, where's that next phase of consumption growth going to come from? And certainly Greek yogurt is a great success story. And cheese, you know, we're going to keep eating cheese because we love cheese. But I would argue that the demand story for the next 30 years is going to come from outside our borders. And the process is already underway. Over the last 6 years, most of our incremental growth in milk production has been sold overseas. Because right now, it's all one big market, and we don't differentiate our customers between here and there. I mean, the world is going to need our milk, and as long as we can ensure an adequate supply, we're going to continue to be a big player. That runs through it. I would be happy to take any questions.
I'm not familiar with what happened in 2009. There's a dip in production on your one ground. What was the cause of it?
I'm sorry, a dip in milk production? Okay, the question was, what happened in 2009? Was there a dip in production? Yeah, I mean, world milk prices crashed, and so U.S. milk production declined. You know, I mean, there was a margin squeeze. Margins were at record lows, and farmers killed hundreds of thousands of cows, and our production dropped off. Yes, sir.
Competition for feed grains worldwide, and you seeing Oceania as being kind of the cap on pricing. Do you think the U.S. dairy industry is going to have to look stronger at maybe mimicking the diets that are filtered dairy out of Oceania?
The question was, with global feed grain prices higher and Oceania kind of being the ceiling on prices, are we going to have to kind of look at more of a New Zealand style of dairying? You know, we're just not set up that way. I mean, the U.S. production model is to crank out high volumes and feed and have big cows, and we feed them grain, and I'll steal something from Dennis here. I mean, you know, Dennis Halliday wrote a nice article a couple of weeks ago. He's looking down. He just won't look at me. Yeah, I mean, Dennis had an article a couple of weeks ago. You know, looking at the New Zealand style, and you know, talking about what the U.S. would have to do. Let me figure out how to answer that question. Yeah, I mean, I just don't see the volumes being able to handle that. I don't know if that answers your question. I'm sorry. Jim Dickrell.
Politics aside, what would happen if we get a Trans-Pacific trade agreement? Would that open up a lot more opportunity for the U.S.? Or would we see more coming here? Or what would happen?
I mean, the main opportunity in the question was what would happen with the Trans-Pacific Partnership Agreement. The main opportunity is if we can get Canada in on that agreement, because right now they have a protected market. So if we can get Canada in on that agreement and have them open up some of their access for dairy, then we would stand to benefit tremendously. Yeah, we do, but I mean, we could, we could certainly ship more. I mean, it's a good market. It's right over the border, and we would be, I think we have a lower cost of production than they do. I mean, quotas and supply management stuff aside, and I think we would benefit from being able to serve that market.
Does US DEC partner at all with cooperatives working together, and so what should we have to do with them?
The question was, does US DEC partner with cooperatives working together, the CWT Export Assistance Program? We provide some information to them in terms of global market prices, so they get, we provide a little input to them so they know how much subsidies to give. But that's the extent of it. Yes, sir.
Talk a lot about, export, global exports of all different kinds of dairy products and grain prices. What about the beef side of the equation? I mean, a lot of the culling that's going on in the country, partially for the feed cost, but it's also because beef price is really strong. And so I guess my question is the world beef price as strong as, and how's our exports, how's that affecting the beef side of it?
Yeah, honestly, I don't really I would, if I had to guess, knowing that much about it, I would guess that world beef prices are relatively low, but I honestly don't track like beef exports. I mean, certainly as we cull more cows, I mean, it's going to take a couple of years for us to build back our herd. I mean, if we take out 100,000 cows or this year or something, then it'll be a couple of years before we can ramp up production again. So I mean that may be an implication of that. I don't know, that probably didn't answer your question, did it?
I'm just kind of, to me, the high beef price is kind of also assisting in the high culling, which is reducing the production.
Yeah.
And I just wonder what the long-range forecast is on beef.
I think the long-range forecast is that beef prices would be high if corn stays high, because ultimately I think they all have to kind of be linked.
Everything's connected.
And it's all one big web.
Yeah, you mentioned the price relationships. You said low-cost suppliers can't supply it all. And you said, do you think the price by next July has to move higher? I missed that.
Oh, sure. The question was about that low-cost suppliers can't supply at all. So, and he was asking when I thought prices would start, our prices would move higher. I mean, it could happen as soon as within a month or two, but I think certainly by next spring. In the back.
Yeah, Alan, back in December 2008, when the credit crunch froze up the world, our buyers, export buyers, couldn't get credit to export. They wanted to send it on good faith. And that melted back up on us because of the 2009 issue, with banking problems in Europe and around the world, and everything being pushed off after the election. What's the chance of a double dip or reflection of that? Because back early December 2008, we were predicting $20 milk to $25 milk, just like we are right now.
Yeah.
What's our chance?
Steve in the back wants me to predict what's going to happen with the global economy. And I mean, there's a few differences between now and then. I think, the credit doesn't seem to be as much of an issue. I mean, it seems like some of the credit issues in particular got kind of addressed. Like structurally, I think some of like the economies like in Southeast Asia, they've kind of tightened things down. Like some of the economy, like whereas China's GDP growth is slowing, I mean, it's not like 8% anymore or something. And so we get all concerned about that. But like in Southeast Asia, like in Singapore and Indonesia, those economies are actually really strong. So I'm hoping that mitigates some of that. And then the other big difference would be that just since 2008, I mean, dairy's more entrenched in the diets than it had been 4 years ago. So, whether we have a global recession, I'm just flipping a coin there. I mean, we operate on the premise that we won't, but.
Al, what role does global currency exchange rates play in the whole import-export, where it's coming from, where it's going?
Okay, the question.
For instance, that's come way, way down. And I wonder if that's caused a surge in the exports of dairy products.
Okay, the question was about currency exchange rates and what impact that has on our export performance. U.S. dairy trade is done in U.S. dollars, so when the dollar is weak, it makes our prices, okay, let me back up. Dairy trade is done in U.S. dollars regardless of who's selling it, so even New Zealand sells in U.S. dollars. So if the dollar is weak, it makes dairy cheaper for everybody. So it actually increases, it's a good thing for consumption for everyone. We don't necessarily have a competitive advantage there, it's just, it's a good thing for consumption. And when the dollar is strong, it makes dairy more expensive for everybody. So normally weak would be a bad thing, but like in our particular case, a weak dollar is actually good for exports. And Mike.
If you take a look at the Australia-New Zealand market, they've traditionally fulfilled that supply-demand into those growing economies. And now, as you look at a future, look at those economies, the Indias, the China, Latin America growth, that well outstrips New Zealand and Australia's ability to fulfill that. Won't that have a large impact into the future, into that 20, 30-year window you were looking at?
Yeah, absolutely. The comment in question was that New Zealand and Australia that have traditionally been able to satisfy some of these emerging markets won't be able to produce enough to satisfy as their demand increases. And yeah, absolutely. I mean, at some point, the world has to pay more money to be able to incent people to produce enough milk to satisfy what people are going to want. So, we're in a relatively good position because in the United States, we can, we have we have the capacity to expand, whereas in a lot of places they don't. So, if the price is right, and the resources are there, people will make milk in this country, and so we stand to benefit as much as anyone. All right. Thanks for your attention. I appreciate it.